Hello and welcome to the lecture for week 6. This week we primarily focus on bank reconciliations and why they're important, but I want to talk about it kind of in a larger way first. So the purpose of reconciliations in general is to compare internal information of a financial matter with external information and arrive at what the truth is, which is often somewhere in between those two. That applies to, of course, bank reconciliations. What does a bank say we have in our bank account? How much cash do we have? And what does the company say? And what is the difference between those two? So what is the true balance in our cash account? What should it be? But it can also apply to accounts receivable. We can send statements to customers and they will reconcile what they believe they owe us with what we believe that they owe us. And we can reconcile the difference between the two. A very important internal control is that statement should be sent to customers every month, representing what we say that we owe them and what the activity on the account has been. And they should be directed if they have any questions or see errors to communicate that with somebody that is not involved with billing clients, applying credit memos or debit memos, and recording cash received from clients. So somebody outside of those functions should receive inquiries from customers about their balances. The same is true with accounts payable. Our suppliers will send us statements, and somebody that's not involved in purchasing activity or paying vendors should reconcile those statements with what the company shows that they owe those vendors to determine what the truth is and resolve any differences. There will often be differences. As an example, a supplier may send us a statement and it may show a particular balance, but we know that we made a payment at the end of the month that the supplier had not received yet. So that would be a legitimate difference that we could research and document. So what we're going to talk about here specifically are bank reconciliations. I also want to talk about kind of different types of controls. So we talked last week about preventative controls. So requiring approvals for transactions, require documentation for transactions, separation of duties, sequential numbers on documents. Those kinds of things tend to prevent errors or fraud from happening. What we'll talk about this week is a detection type of control. So if something inappropriate has happened, how do we find that out and ensure that it doesn't happen again? So our textbook has a good definition of a bank reconciliation. So it's an internal financial report that explains and documents any differences that may exist between the balance of a checking account as reflected by the bank's records and that of the company's records. So the benefits of reconciling our bank accounts, and to be clear, we should reconcile every bank account that the organization maintains every single month, period. So one, it'll help us to determine if fraudulent transactions are occurring. I reconciled my company's bank accounts for years and years and never found any instance of fraud until one day I found checks that were clearing my account that we had not issued. So somebody had gotten a hold of one of our checks and used some techniques for altering the ink on the check to make it payable to somebody different and in a different amount. So I was seeing checks clearing my bank account in unusual small amounts, $113.37, $215.37, things like that. And when I saw that we had not written those checks, I contacted my bank, who contacted the legal authorities, and it was corrected. We ended up having to close that bank account and open a new bank account. But the key thing is I wouldn't have found those small amounts clearing my account fraudulently if I hadn't done a bank reconciliation. It'll also help us discover errors that are made by the company. So transpositions of numbers, dropping a digit, those kinds of things we can catch in a bank reconciliation because the bank knows the truth and we don't, and we can correct those with adjusting journal entries. We may find errors that are made by the bank. It doesn't happen very often, but it certainly can happen, and we need to communicate with the bank and have those things corrected. And then we may identify transactions that may not be reflected in the company's accounting system. So transactions that have hit our bank account that for one reason or another, we have not recorded in the accounting system, but we need to. So first, a little bit about bank terminology. So banks use debit and credit memo differently than we do. So from our perspective, a debit increases our cash account and a credit decreases it. Well, the banks look at that in the opposite way. They look at it from their perspective. So a debit memo is a decrease to our account balance. So when a bank debits our account, they're reducing our account. When a bank credits our account, they're increasing it. And I won't get into why banks use those terms that way, but it's just good to know. Debit memo it decreases our account. I almost said it wrong. And a credit memo increases our account. So a little bit on terminology, which many of you probably are familiar with. An outstanding check is a check that we've written and we've sent it to our client or our supplier or whoever it is that we owe the money to, but it hasn't yet cleared our bank. So that other party that we wrote the check to, either they haven't received it yet or they've deposited it with their bank and their bank has not cleared it with our bank. So our bank's not aware of the check. A deposit in transit is a deposit that we've recorded, but the bank has not yet shown it. So maybe we bank with a bank that's far away from us and we need to mail them the deposit. Maybe we take it to a night deposit box after closing hours on the last day of the month, so the bank they have not processed that deposit yet. It's not reflected on the bank statement, but we record it as being made on that day. A bank service charge, of course, is the fee that the bank assesses for the services that they provide. So it's a reduction of our cash balance that we will see on the bank statement. And then non-sufficient funds. We'll talk about it here from the perspective of somebody gives us a check and they don't have the funds to cover that check. So when our bank goes to clear that check with the writer of the check's bank, that bank says there aren't adequate funds to cover that check. And so when we initially made the deposit, our bank account increased. Well, now when the bank finds out about this, they decrease our account. They take money back out of our account for the amount of that check. And there might be penalties or things like that associated with it. So here is an example of a bank statement, and just about every bank is going to use a slightly different format. The things that are key to note here is an account number. We'll have a different bank statement for every account. The period of time for which it reports activity, in this case it's June 30th through July 31st. And then a recap. So what is the beginning balance? What deposits were recorded by the bank? What withdrawals were recorded by the bank? What other kind of adjustments occurred, and what is the ending balance. The ending balance is a key figure for what we're going to do. Then it'll show the activity on our account. So it'll show in check number order all of the amounts that have cleared our account, so checks that have been presented for payment that the bank has cleared. It will record all of the deposits in chronological order that have been made to our account, and then any other kinds of miscellaneous charges. So in what you see here are ACH, which stands for Automated Clearinghouse. Those are non-check related transactions, kind of like wire transfers in a way. There is an NSF check shown on this statement, and a service charge shown on the misstatement, and then a miscellaneous item. May have been printing checks or something like that. So the bank statement, here's another view of the recap of how we got from the beginning to the ending balance on the bank statement. Well, in our company records, we're probably going to have a different beginning balance. We're going to have a different deposit figure, a different checks written figure, and a different ending balance. So the key thing about the reconciliation is to say, which of these two numbers is correct? And if neither of them are actually true and correct, then what point in between them is the correct amount? So there are two sections to a reconciliation of our checking account. One is the bank section. The bank section is going to start with the ending balance reported by the bank. And then we are going to adjust that for anything that we know about that the bank does not know about. So we will add deposits in transit. So those are deposits that are not reflected, are not inherent in the ending balance that the bank has reported to us. They didn't know about it. So we will add those because we know about it, the bank does not. We'll subtract any outstanding checks that we've written. So we'll have to do a side-by-side comparison. What did the bank clear? What did we write? And determine which checks have cleared and which checks have not. Again, the checks that have not cleared the bank yet, the bank doesn't know about those. It's not inherent in the ending balance the bank gave us, so we will subtract those amounts. If they had cleared the account, they would have reported a lower balance. The other thing that's not noted on this slide is we will add or subtract the impact of any errors the bank made, because in those cases we know the truth, the bank does not. That will then give us an adjusted bank balance. The next section is the company section. So the company section starts with the ending balance in the company's records. And we add any amounts the banks have added to our balance. So maybe somebody made a deposit directly to our account at the bank and we weren't aware of it. We'll add that. And then we'll subtract any charges that the bank has made to our account, any reductions that they've made that aren't reflected in our accounting system. We'll also record the impact of any errors that we have found. And the way we'll record that is the difference between the impact of the error. So the difference between what the correct amount and what we actually recorded. And that could cause us to increase our cash balance or decrease it. That will then give us an adjusted company balance. And that needs to equal the adjusted bank balance in order to be reconciled. So here's an example of a completed reconciliation. So you see the top section there, the cash balance according to the bank statement. We add the deposit in transit. We subtract 3 outstanding checks to come up with an adjusted balance of $2630.99, an amount lower than what the bank reported. And then we'll start with our cash balance, $2549.99. We'll add to it deposits that the bank has made that we have not recorded, and we'll subtract charges the bank has made that we have not recorded. And you can see in this case we get the same adjusted balance. That's how it should work. If it doesn't work, you'll determine what the difference is, try to search for that error. You may need to go back to the prior month to determine if that reconciliation was done correctly. Generally, errors are a result of charges or increases in our account made by the bank that we have not reflected in our accounting records. That's generally the source of differences between the two. The next step is important. Once we complete the reconciliation, we'll now have to go and make an adjusting journal entry in our accounting system so that the transactions in the company section of the reconciliation, so the note and interest that was collected, the bank service charge, and the error on that check, we'll want to make adjusting journal entries to reflect those transactions so that our ending balance on our trial balance after we've posted those to the general ledger, in this company's case, should be $2630.99. Now, the other thing I wanted to talk about is a proof of cash. And a proof of cash is going to find errors that a bank reconciliation wouldn't find. And I should actually not errors. It'll find fraud that the bank reconciliation would not find. We would do a proof of cash if we were concerned about a lack of internal controls in an entity. So we may have a division that has its own bank accounts, and if in that division we find that the same person is involved in cash disbursements, is also involved in cash receipts and deposits, that would be a lack of separation of duties, and that would cause a concern. So in that case, we would do a proof of cash to satisfy ourselves that nothing inappropriate was taking place. So what a proof of cash is going to find is, are there cash receipts and disbursements that were recorded in the accounting records but are not reflected on a bank statement? So is somebody manipulating the accounting records in some way that isn't tied to actual bank activity? More importantly, it'll find cash deposits and disbursements that are on the bank statement but are not shown in the accounting records. So that would be an example of somebody depositing money in the bank and then withdrawing that or wiring that money to themselves and never recording that activity in the accounting records. If somebody did that within the same month using the same account, we would be able to reconcile at the end of the previous month, the end of this month, both would reconcile perfectly and we wouldn't find that kind of error. And then we can find cash receipts and disbursements that are recorded at different amounts by the bank and in the accounting records. So here's an example of that, and this one is a little bit complicated because it's a result of it's done by an auditor, an outside auditor, so there's a lot of tick marks and check marks and all of that sort of thing on it. I would encourage you to take a look at the solution to the in-class practice. There are 2 in-class practices or actually 3 in-class practices. So I would look at the third one, the proof of cash problem, and see how that's reflected. But in effect, the top line is showing the activity per the bank, the bottom line is per the books, and we would have a third line that would be the calculated balance per the books that would show a difference between what it should be and what is being reported. So again, I would recommend looking at that in-class practice. So finally, complete the homework assignment and then read section 12.1 through 12.4. We'll talk about that next week. Thank you very much.